Another key element of financial analysis is how we actually value a company. I've coached 302 Haskane teams to over 180 podium finishes. There are three main professional methods: discounted cash flow, comparable company analysis, and precedent transactions. Each has strengths and weaknesses. The best answers usually combine them for a realistic range. This is part of the Case Finances and Excel Mastery series. Turn numbers into compelling insights. Let's break these valuation methods down. Before we dive into the methods, we have to understand a couple of fundamentals. Capital structure is the mix of debt and equity that finances the firm. It affects risk, especially the ability to make interest payments. There's enterprise value, the total value of the firm, which is the equity plus the debt. The equity value, which is the value to the shareholders only, what the share price reflects. These concepts matter across all valuation approaches. Discounted cash flow is the most sophisticated and forward-looking method. It calculates the present value of expected free cash flows available to all capital providers minus the capital requirements for growth. The key challenge, it's highly dependent upon your assumptions, and the terminal value in perpetuity, often drives most of the total value. Be cautious and test without it for a shorter term sanity check. You can use the weighted average cost of capital, WACC, as the discount rate. The company must beat its cost of capital or it destroys its value. Comparable company analysis uses multiple similar public firms. Enterprise multiple values, EV over EBITDA, EV over sales, EV over cash flow, or equity multiple values like PE, price earnings, or price over cash flow. Precedent Transactions looks at what buyers actually paid for similar companies in past deals. It's realistic and based on real market transactions, but it can be affected by changing market conditions and limited public data. These methods all help you benchmark what the market is willing to pay. There you have it, the three main company valuation methods: discounted cash flow, comparables, and precedent transactions. Use them together for a credible range and always explain your assumptions. This is part of the Case Finances and Excel Mastery series. Turn numbers into compelling insights. Drop a comment. Which valuation method do you prefer in cases? DCF, comparables, or precedent transactions? Subscribe and hit the bell for the rest of the series. Cam Walsh out. Go value companies with multiple methods for stronger confidence.